Okay, I just heard.
Yeah, so the broadcast just started. All right, good morning, everyone. Welcome to the 2020 Northern Virginia Housing Expo. Today's webinar is presented by John Tomasello, the Vice President of Residential Lending for Burke and Herbert Bank. You can find more information at our virtual exhibit hall, free private financial counseling, and a schedule for the rest of the webinars on our website, novahousingexpo.org. And if you know someone who couldn't be here for today's presentation, it will be posted to our website at 2 p.m. We will be taking questions throughout the presentation. You can ask questions by clicking on the circle with a question mark on the right side of your screen. Thank you, everyone, for being here today. And without further ado, I will turn it over to John Tomasello.
Okay, thanks, Cameron. So I guess we had a little technical difficulty there, but can everybody hear me now, hopefully? So we're going to start over from the first slide, and the question is, are you ready to buy? I am John Tomasello. I am the Vice President for Residential Lending at Burke and Herbert Bank. We are probably, I think, the oldest bank in the state of Virginia. If not, then we are definitely one of them. We're $3 billion in assets. We are one of the strongest banks with a pretty substantial net worth. So without further ado, let's get right into it. So what do you need to know when you start to look at buying your first home? What hurdles do you have to overcome? Most people think it's credit, but typically it's not. Typically it is the cash you need to buy the home. So what's involved? How much of a down payment? Do I need an appraisal, a home inspection? Do I have a plan? So when you buy a home, you get a mortgage, and in the mortgage you have principal and interest, but you also have taxes, homeowners insurance. You might have a condo or an HOA fee. You might have private mortgage insurance if you're putting down less than 20%. So these are things to consider when you're looking at buying your first home, and you want to have a plan before you go into it. And then the question becomes, should I rent or should I own a home? What's involved? So we prepared this slide, and you can see on the left side of the slide that for a typical rent in Northern Virginia all the way down into Fredericksburg, it's about $2,000 a month. You have no tax write-off. You don't get appreciation, you don't get equity buildup, and you run the potential for your rent to increase every year or every other year, a couple percent a year. So in our assumption, in 10 years, you've probably paid over $300,000 in rent over that 10-year period. So let's go to the right side of the screen. So in a typical mortgage, that's almost $40,000. Your principal and interest payment's about $1,524 a month. But when you add the taxes and insurance and possibly an HOA, now you're up to $2,374. So you might think, well, wow, that's $400 more than rent. But let's look at it after 10 years. You've paid down the loan $76,000, so my balance is only $262. So I've got that going for me. And then with the price appreciation of the home, lately we've seen prices going up 2 to 3%, and lately, unfortunately, with the virus, the supply of homes on the market is pushing the prices up. So, it's a good time to buy right now. And then the last line you'll see on there, so you have $163,000 of equity built up over 10 years. It's a pretty nice nest egg. But the last line shows you that you're getting a mortgage interest reduction. So at the end of the year, when you do your taxes and you can put on there how much interest you paid, you're going to get an interest tax deduction that's $4,200 a year, give or take. These are all estimates. But what that works out to is about $360 in tax deduction each month. So that $2,400 mortgage payment really is more like $2,000. So, apples to apples, it's the same as renting, but over 10 years, I've built up $163,000 of equity. So if I ever sell the home, I've got that going for me. That's just cash in my pocket or more money that I can use to move up into a bigger home. So the next slide, what can I afford? Let's see here. So you have to keep in mind that there are, bills associated with home ownership. You have utilities, water, heat, air conditioning. You have some repairs. If you buy a new home, you won't have as many for the first 10 or 15 years. But if you buy a resale, then you might have some repairs you might have to make. And then there's just your regular upkeep, things like, keeping the decks clean and, washing windows and things like that may not come with renting. What can I afford? That's what everybody wants to know. How can I afford? If someone came up to me and said, I make $100,000 a year. What can I buy? Immediately my mind goes to, well, pretty much you can get a mortgage for about $400,000 because it's 4 times whatever you make in a year. So without thinking, that would be my answer. But keep in mind that the more you make, the more discretionary power you have. So if you're making, say, 80 to 150, you multiply that 4.5. And if you're making closer to 200,000, you can multiply that by 5. Now, these are all estimates because it really depends on your debts. But yeah, if somebody's making $200,000 a year, believe it or not, they can pretty much get a loan close to $1 million. Okay, so what's it going to cost me? What are all these things that I have to pay when I buy a home? It isn't just the down payment. There's closing costs. Now, closing costs, on the left side of the screen, you'll see the basic closing costs. Most of these are not going to be negotiated. I will point out, though, that we have an appraisal on there. And a lot of the agencies and investors that buy the home now, they built this massive database of homes that they know what they're worth without even having to look at them. And so they'll discount that a little bit. And I would say right now about 30 to 50% of the loans that we're doing do not even require an appraisal. So that's a recent development, but you may not have it. It just depends until we put the loan in the system and see what the home's really worth. On the right side of the screen, you have the items that are completely non-negotiable. You will have to pay them. You cannot get out of them. Those are your municipal transfer taxes and recording fees. You'll have to have homeowners insurance to protect the home from fire and things like that. And of course, you'll have to pay property taxes. In Virginia, they're paid in arrears, but in Maryland, they're paid up front. So this is probably the very basic. If you buy a home that's for about $400,000, you're going to spend about $10,500. But keep in mind that if you buy a home in Maryland or you buy a condominium or a townhome with an HOA, they could be substantially higher. So in Maryland, because they have transfer taxes that are quite a bit more than Virginia, you might need an extra $7,600. That's not anything to sneeze at. If you buy a townhome with an HOA or you buy a condominium, they need working capital up front, so you might have to put down another $2,000. But in Virginia as a whole, they typically run 3 to 3.5%. Maryland runs 5 to 6%. And this is all based off mainly the sales price, but some of it's based off the loan amount. So if a lender's charging you points, you have to add that in as well. So obviously that could add, another $10,000 to what it costs you to actually get into the home. What loan can I get? So it depends a little bit on the interest rate and the type of loan you're getting, but we don't like your total mortgage payment and all your other debts, like credit cards and car payments and student loans and alimony and all that stuff, to be more than 45% of your gross income. So if your gross income, that whoever's on the loan, whoever's qualifying, is say $100,000, then we don't want all your debts combined to be more than $4,500 a month. So if you simply take all your monthly debts and divide it by 0.45, multiply it by 12, you can see that for this loan, this person needed $80,000. And I think that was our $350,000 mortgage. That's not the cost of the home, that's the loan itself. So, which works pretty close to about 4.5 times their income. All right, so on to the next one. Now you're ready to start buying. How do you decide on a lender? Most people would get a referral from somebody that they know. Other people might shop online. Do you want your loan to stay with that lender? Burke & Herbert actually does portfolio loans. So we might be able to do a loan where you don't have to worry about the loan being sold. But most lenders do sell their loans to some of the bigger institutions that hold them. But do word of mouth as well. Get somebody who's got a reputation. Make sure that you're asking the right questions. Meet with the lender. Make sure that the lender gives you all the information about how to complete your application, gives you detailed analysis of what the payment's going to be. make sure you're in control of the documents that you're going to need, and we're going to get to that slide in just a minute. Most importantly, though, make sure they give you a cost worksheet so you can compare from one lender to the next. A lot of lenders out there will advertise like 2 3/4% when the market really is 3 or 3 1/8. Why do they do that? Well, they're probably charging points, but there's a calculation called APR, annual percentage rate, and that will give you the ability to compare one lender to the next. If one lender is charging you 2 3/4 and the other is charging you 3 or 3 1/8, look at the worksheet and see if the one lender that's much lower is charging you points, because each point is worth 1% of your loan. So if you're getting a loan for $350,000 and that other lender is charging you 2 points, well, that's $7,000 up front. It could be beneficial to you to do that. It just depends on your personal situation and whether you need that lower rate to qualify.
Hi, John, I got a quick question for you. And the question is the 45% a standard all lenders use?
No. For most of your investors, like VHDA, they do have a maximum of 45%. And if you're getting a grant from the Federal Home Loan Bank, they will require that you keep your debt under 45%. But technically, VA, for instance, has a posted 51% guideline, although I've seen them go up to 62. FHA, you can technically go up to 57, and conventional loans typically limit you to 50%. So no, it's not a hard and fast rule, but would you really want your mortgage and all your debts to be 60% of your income? After taxes, you have no money left over. So you got to decide, do I want to eat or do I want to have a place to live? It's personal preference sometime, and I have seen a lot of loans get approved well over 45%, but typically those people have phenomenal credit and they're putting down pretty substantial down payments.
Great, thank you.
Hopefully that answers that question. So this slide, these are the basic documents that you're going to need. You'll need pay stubs to show what I make. They shouldn't be handwritten pay stubs. We don't always ask you for tax returns, but if you're self-employed, we will. But if we're concerned about one thing or another, if you have a side business, make sure you give that information to your lender. A lot of times we get a loan in process and then we actually pull their tax returns from the IRS. People don't realize we do that, but we do, just to verify and substantiate the information that the customer gave us. And we say, oops, look at that. There's something on their tax returns that they didn't tell us about. So we'll look for your W-2s. If you're self-employed or you're a contractor, we'll ask you for 1099s. We'll ask you for proof of assets. A lot of people will just give us the first page, which shows us the balance. But nowadays, what we look at is we look at every line on that bank statement to see if there's a lot of deposits or withdrawals going in or out, and we'll wonder, well, where's that going to? So if there's money coming in, we'll wonder if somebody's been subsidizing that customer over a period of time, which we don't like to see that, or we'll see maybe $500 a month going out, and we'll wonder what's that for. Could be from alimony, and they didn't tell us that they had to pay alimony, and that would go into their debt ratio. So these are the basic documents that you'll need, but you could need a lot of other documents. That's why it's important to get with your lender and give them the whole story, because they'll know how to work around it. All right, so this is probably the most misunderstood section of getting a loan is what's my credit? What credit do I need? The typical customer across the country, the average credit score is about 660. Now, I get a lot of people who call me and say, well, I just pulled my credit report and I'm a 815. Well, I'm going to say if I do 1,000 loans a year, then probably 10 people will have an 800 credit score. And the reason for that is that when you go on to get your own credit score through another agency, they're probably only giving you what's called an in-file. We use what's called a tri-merge. So we get your scores from 3 different bureaus, and we use the lowest middle score of all the borrowers. So if there's 2 borrowers, we use the lowest middle score. Now, why is the score lower when we pull it versus when the customer pulls it? That's because when you're getting a mortgage, your blemishes are weighted more heavily on a mortgage than they are on something like a credit card or a car loan. So if you missed a payment on a mortgage or a car loan, your score, let's say you missed it in the last year, your score is going to go down at least 100 points probably. Whereas if you're getting a credit card, it might only go down 20 points. But so again, in a mortgage, we weigh your blemishes much more heavily. There are a lot of different ways to increase your credit scores. Make your payments on time, keep the balances on your credit cards below 50% of the available balance. A lot of people think, well, what if I pay off this car loan? And we advise people, don't always do that. The reason you don't want to do that is because if you've been paying that car loan on time and it's not affecting your ratios, if you go and pay it off, well, now it's not going into your credit score. So that would be a favorable thing if it stayed on there. So again, talk to your lender, make sure that they know the full story. And this thing that this little beach ball that just bounced in there, that'll tell you how much of your score is affected by what you do. So obviously, the bulk of your credit score is based on do you make your payment on time? How many people have inquired into your credit score? Because if you're getting declined by 1 or 2 or 3 lenders, that'll show up on the credit report. We'll see that and we'll wonder why did they get declined so many times. The types of credit you use. If you have 10 or 15 credit cards, we don't like that. We prefer that you just have 1 or 2 that you use all the time and keep the balances below 50%. So that might be an option to consolidate that. Now, what we can do is when you apply, we have a program on our computer where we can put your credit report into the computer and we can say, what does John Doe have to do to increase his credit score 40 points? And it'll tell us. Or we might say, well, if they paid off this credit card, how much would their score go up? So we can do it one of 2 ways, and we can give you an idea what you need to do to increase your credit score. But the minimum credit score, people always ask me, it depends on the program. For instance, FHA doesn't technically have a minimum credit score, believe it or not. But most of the investors that buy the FHA loans will say, we don't want anything less than 640. So, and with the coronavirus, it's gotten a little bit tighter. So some of them actually went up to 660 and 680. But conventional loans, 620 to 640 is pretty much the lowest they're gonna go. So hopefully that's enough about credit. That gives you an idea what you need to do. If you're under the 620 or the 640, definitely, contact your lender and ask them if they can do a credit search to basically see what you need to do to get that score up. Okay, so let's go right into what kinds of loans there are. So there's fixed loans, and that's 99% of all the loans we're doing right now are fixed rates because they're typically, for the basic 30-year fixed rate loan is around 3%. Government loans are a little bit lower. Adjustable rate loans, 2 3/4 to 3.5. But why would you do that when you can get a 30-year fixed rate at the same rate? So that really doesn't make a whole lot of sense. Are there loans for first-time buyers? Of course there are. And so let's go right into the next slide. Who has loans for first-time buyers? Basically everybody does. But some of the loans are a little more difficult. Others are a little easier to get. So your conventional loans are probably the most strict. A lot of those loans are insured by Fannie Mae and Freddie Mac. A lot of people think that Fannie Mae and Freddie Mac make the loans, but they don't. They securitize them and they insure them, but they don't usually buy them or make them. They'll go up to 97% of the sales price. They have minimum contributions that are anywhere from $1,000 up to 3.5%. For those types of programs, your income cannot exceed 100% of the median, which means that in this particular area, like Northern Virginia, the median family income is about 120, I think, right now. So your household income cannot exceed $120,000. For grant type programs, they actually like it to be under 80% of that number. So 80% of that is only about 96, which you might think is a lot of money, but in this area to buy a home, it's not that much. Minimum credit scores for those types of loans are on this as well. But for your typical conventional loan that's not a first-time buyer or not FHA, then you're going to need 3 or 5%. And we're going to get into that in the next couple slides. FHA, a little bit easier to qualify because remember, FHA allows you to go up to 57% of your income. Their down payment is 3.5%. They don't have minimum $1,000 contributions like conventional loans do. It's the down payment's 3.5%, but the rate's typically a little bit lower than a conventional loan. But FHA loans have mortgage insurance. Doesn't matter how much you put down, FHA has mortgage insurance. And on the typical loan, it's about $300 a month, give or take, but it depends on the loan amount. The good thing about FHA is you can get gifts for the down payment. A lot of conventional loans do not allow the customer to get a family relative gift for the down payment. FHA is a little generous on the qualifying ratios. We told you that they'll go up to 57%, whereas conventional loans typically keep you at 50. And when I look at customers, I use 45 because I think that's a fair thing to use, knowing that I could go higher if I needed to. Conventional loans allow the seller to give you up to 3% plus what's common and customary for your closing costs, whereas FHA allows you to go up to 6%. This is critical because if you're trying to qualify for an FHA loan, even though your basic closing costs might only be 3.5%, you might be able to use the seller or the builder's money to help buy the rate down to help you qualify. So, and again, FHA does not have a minimum credit score, but typically the investors will want you to be over 620 or 640. VA loans are the easiest to qualify for. Obviously, you have to be a veteran of some type, and how much you can get on a VA loan depends on your eligibility and how much eligibility you have, and you have to ask the VA to give you your certificate of eligibility so that we can plug it into the computer and we can know. But anything up to 484,000 is 100% financing. That's where most of you as first-time buyers would probably fall. If you go over that, you might need a very, very small down payment for VA, but probably not. VA also allows the builder or the seller to pay almost all your closing costs. And as we said earlier, VA allows you to go up to a 51% ratio. Would you want it? Probably not. But could you? Yes. I have seen VA loans go up as high as 62 and 63% of your gross income. I don't know why anybody would want that, but we have seen it. In fact, VA actually allows you to get your down payment even off a credit card, believe it or not. They don't have private mortgage insurance. They do have a commitment fee up front, but you can finance that. So again, if you're a veteran, that's the direction you want to go. Then there's the VHDA, which is the Virginia Housing Authority. They changed their name just last week, actually, to Virginia Housing, so they dropped the Development Authority. These are great loans because they will actually give you a second loan that will help you pay for the closing costs, even the down payment. They also allow you to use mortgage credit certificates, not for qualifying, but up to 20% of the annual interest you pay can be used to offset, so you get a tax deduction for that. That's big. That's worth a lot of money to you. Every monthly payment is going to be reduced a couple $100 at the end of the year. You don't get it each month, but it's a big selling feature. They don't have what's called LLPs, loan level pricing. What that is that if you're putting down less money, so let's say you're putting down 10% as opposed to 20, and your credit score is only 640 as opposed to 740, then the rate's going to be higher or you're going to have to pay more points. That's the way conventional loans work. FHA doesn't do that, and neither does VHDA, neither does VA. Conventional loans do. So you might be wondering, why did my neighbor down the street get 3% and I ended up with 3.5? That's because if you have a lower credit score and you're not putting down as much money, you have a loan level pricing adjustment. VHDA requires that the buyer contribute 1% but that's not typically a problem when we're buying. So how much do I need as a down payment? Some borrowers don't need anything. Again, VHDA, the last one I did, didn't need a penny. A lot of conventional loans that are Home Possible or Home Ready, they can get gifts, but you know, the down payment typically will be 3 to 3.5% for most loans. If you don't put down 20%, then you would have private mortgage insurance. Everybody always asks me, what is private mortgage insurance? What that does is the lenders charge it to protect them if you don't make your mortgage payment. So among all the customers that pay mortgage insurance, maybe 1% of the people don't pay their mortgage. So all of the rest of the people are basically subsidizing it by paying this insurance so that that one customer will be able to pay off the investor. It's required. There's not a lot you can do about it. There are lenders who will do what's called LPMI, where instead of actually giving you private mortgage insurance where you make a separate payment, they simply increase the rate. And most lenders offer that, and it's called lenders paid mortgage insurance. All right. So where can I get the money for the down payment? Well, most people get it from savings. Some people can withdraw it from their 401k. Some people get contributions from family. What you don't want to do is tell the lender, oh, I've got it, don't worry about it, because the lender will say, I'm sure you do, but I need to know where it's coming from. And that's really critical because a lot of people can't show us that. They've either got what we call mattress money, which is cash under the bed, so to speak, or they're getting it from a relative, but it's not allowed. It may not be a close relative. And the guidelines are very clear that it has to be a pretty close relative in order for you to get a gift. And why is this important? Because the single biggest reason for defaults has to do with how much money our customer actually put into the transaction. So the more you put down, the less likely you are to default. And that's why it's so critical that we verify exactly where this money's coming from. We're going to get a little bit into grant programs, but we're not going to spend a lot of time on it. There are grants available for first-time buyers. Burke and Herbert Bank offers them through the Federal Home Loan Bank. You must be a member of the Federal Home Loan Bank to offer these, which we are. But in essence, for every dollar that you put into the deal, Burke and Herbert Bank will give you $4 to help you with your down payment and your closing costs. So, but again, you must be under 80% of the median family income for a two-person family. That is about 70,000. I think it just went up to 75. But for a four-person family, I think it's currently about 96 or 97. Last year it was 94,000. But yes, there can be children who are working, who are living in the home. You can use their income to qualify. For veterans, we can actually give you grants up to $10,000. Again, ask your lender if those are available for you, and I'm sure we or they can help you out. And then there are down payment assistance for veterans and National Guards, up to $7,500, and service sector. So if you are a fireman or policeman, a nurse, hospital worker, you can qualify for up to $7,500 grant. Just let your lender know that this is the occupation you're in, this is how much I make. They'll run it through the Federal Home Loan Bank to see if you qualify, and you could qualify for, you know, fairly substantial grant that would help you with your down payment and closing costs. Let's see, we just talked about that. That one doesn't apply to anybody. So now we're into the actual mortgage process. Most lenders have a website online. Ours, you go right to our website, burkeandherbertbank.com, and on there, there's a link. Most lenders have them to their mortgage division, and most of them will say apply online. And you simply go in there, apply. For Burke and Herbert Bank customers, your loan will come directly to me, and then we will assign it to a loan officer. That loan officer will call you. They'll take you step by step through each phase of the application. They'll go specifically which documents apply to you, what you need to do to supply them. So if you don't ever want to meet with a loan officer, you don't have to, but we think it's important that the customers do meet face to face, especially if you're a first time buyer. So the offer is accepted, but there's one step before that. You want to try and get pre-approved before you actually go and put in a contract on your home. The reason for that is it's a pretty it's a supply-oriented market right now, and the supply is very low. So if you go to a prospective seller and you say, hey, I'd like to buy your home, the first thing that they're going to ask you or your realtor is, do they have a loan that's approved? So if you come to us and you get a pre-approval letter, that's a really important, and a realtor or a seller is going to take that much more seriously than somebody that comes to their home asking to buy it and doesn't have that commitment from the lender. It's just a pre-approval. The lender still has to verify all of this documentation we told you about. You're going to probably want a home inspection. We might need an appraisal. We'll have to go through all the closing costs and everything. But that's important to have that when you go looking for the home. Make a plan. Decide how much you can afford. Save towards that goal. Make sure you have enough. And actually, we typically require reserves. So you want to know that you might have, anywhere from $2,000 to $5,000 in reserves. Most of the time, FHA does not even require reserves, nor does VA, but conventional loans do. So, and that's important because, you don't want to be one broken down car away from being defaulting on a mortgage. You want to know that you have enough money to fix something if the roof should leak or the car breaks or the nanny quits. So it's very important to have reserves. Get pre-approved, we talked about that. We're here to help. There are slides at the very end where we have a loan officer's names and their contact information that you can contact them and go through the process and to see where you are and see if you're ready to buy and see if you can put in an application.
Hi, John. So we have another question for you. For the Burke and Herbert Down Payment Assistance Grant Program, is there a minimum credit score you are looking at in order to qualify? Also, do you need to be a customer in order to apply?
You do not need to be a customer. You can simply apply online. They do have a minimum credit score. I think it's 640. I'll check that for you. I think it's 640. You do have to be, for the Federal Home Loan Bank grants, you do have to be under 80% of the median family income. And again, those are ballpark numbers because the median family income varies depending on where you're buying and where you live. So we have to go into each jurisdiction and see what that number is, and you have to be under 80% of that.
All right, and then one more. Is 4 times yearly income the standard used by lenders for determining loan amount?
No, that's just my guideline. If you again, if you're trying to figure out, if you didn't have access to a calculator and you walked into a home and the person said this home is for sale at $400,000, and you knew that you made $100,000 or $110,000, then you have a pretty good idea that at least you're in the ballpark. If you were looking at a home for $600,000 and you were only making $80,000, 4 times 80 is only 320, maybe 4.5, maybe you're at 360, but you're still way far away. So you're going to probably know that there's no point in looking at that home because that looks like it's going to be way out of line for you.
Gotcha. All right, thank you.
Now, another quick way to figure out what your mortgage payment is just take whatever. Let's say the home is $400,000, and forget about the down payment for now. What's my mortgage payment going to be on $400,000? Well, just multiply the 400 by 4.5. So if you do that, your payment's going to be pretty close. 4.5. It's going to be $1,800. That's going to be within $100. So that way you'll have a good idea of what your principal and interest is. But then you have to say to yourself, okay, that's my principal and interest, so $1,800. But I'm going to have taxes, so I'm going to add $500 a month for that. I'm going to have homeowners insurance. I'm going to add $100 for that. And I might have some mortgage insurance, so I'm going to add $250 for that. So if you just walked into a home and didn't know what your payment would be, just take the home, divide it by 1,000, get whatever it is, 400 maybe, multiply that by 4.5, and then add something for the monthly taxes, insurance, and HOA. And that'll give you a real close ballpark of what the payment's going to be on that home.
All right. And then I just had another question come in. If you are looking to turn the property into an investment property, say in 7 to 10 years, do any of these loan options still work?
Well, these are options for people buying their first home. You are required, you'll sign a document when you buy the home saying you will be living in the home for the next year. If you try and convert it to an investment property and the lender finds out, they have the ability to call the loan or, you know, raise the rate, or there's a number of options they could do, but you're supposed to limit it for a year. A lot of times veterans will get transferred in 6 months. That's okay. We understand that. That happens all the time. But for the typical person, if you want to convert it to an investment property after that, that's fine. But if you're looking to buy a home as an investment, now you're going to need a much larger down payment. You'll need at least 15%, and that's only available through Freddie Mac. Fannie Mae doesn't offer that. Typically, the down payments are 20 to 25% for investment property homes, and the rate is almost always 0.5% more and 1 or 2 points in addition to that. So in today's market, that's going to be about 3.5%, maybe 3 3/4, and you'll pay 1 or 2 points to get that rate as well. And you'll have to put down a bigger down payment.
And last question that's showing up here, are income requirements based on adjusted gross income?
So this is a self-employed question. So standard W-2 wage earners, we don't typically look at your net income or your tax returns from that standpoint. When it comes to self-employed or 1099 like contractors, we always look at your tax returns and we look at the net income. So a lot of people, when they do their taxes, for obvious reasons, they try and find all the expenses they can so that they reduce their taxable income. But we don't like that. We actually treat that as expenses that you have. The only thing we don't really treat as a cash expense would be things like depreciation or depletion. So if you, let's say you gross $150,000 a year, but the net adjusted income on your 1040s is 40,000, that's what we're going to use, is the 40,000. And a lot of people will say, well, wait a minute, I'm just writing that off so I can reduce my tax bill. Oh, that's fine, but unfortunately, we can only go by the net income for self-employed or 1099 people.
Okay, great. Thank you.
Okay, well, I appreciate you being there. As I said, in the end of this presentation, there are some contact names for our loan officers, and of course, you can always contact me, John Tomasello at Burke and Herbert Bank. I am the head of residential lending. Cameron, do I need to do anything to sign off or anything?
Oh, no, sorry. I thought there was one more slide. All right, so I'll give.
Oh, there we go. There is one more slide.
So I'm going to give another minute for people to get any additional questions in. Okay. And if there aren't any more questions, then we'll say goodbye. All right, everyone. Well, thanks for joining us. John,
thanks, Cameron.
Thanks,
everybody.
I'll see you next time.